What's up, guys? This is Card Thomas with Coin Mastery TV, Wednesday edition, ready to rock. Nothing to do today. There's no thumbs up, no subscribe. We're just gonna get through today. That's all we're gonna do. So thank you for joining me. Yesterday didn't make it onto the old content platforms. Lots going on. Got a lot of really fun projects I'm working on, but I'm back. We continue to be back, ready to rock. Now, today we're talking about Bitcoin, obviously. We're talking about a few levels. I want to talk a little bit about what happened with EOS, what's happening with EOS, the overall market, a few pieces of news, and then spend a little time talking about a few bigger things happening in the broader market. A bunch of you guys have asked me about this, and we can dive in and talk about it, which I think I'm personally super interested in, and I think it'll help a lot of you guys just see where we stand, where Bitcoin stands, where the global economy stands. I think that's a huge question mark that it's starting to get a little bit of attention. All right, so let me move my thing over so you guys can see the prices. I think that was a great suggestion by someone. So we're looking at Bitcoin. I'm on BitMEX again, or at least the chart, just because as you dive in deeper, you can get better liquidity. And you can see now that all these kind of descending triangles are starting, everybody's got a descending triangle kind of on every single different timeline. Here's the only thing that really matters, in my opinion, is this level. Let's call it 5,900 for anybody listening on the podcast. All I did was draw a horizontal line from the February lows straight over. And I think that's really the next big thing that people are looking at. Previously, it was a trend line, right, for the kind of ascending triangle / ascending wedge, I guess you could call it. Now we're looking at a descending triangle. If you don't know what that means, imagine that this is the base, and then we have a triangle coming down. The reason why it's a triangle is because it has a right angle in it as opposed to a wedge, which does not necessarily have a right angle in it. And you can see that this is a previous resistance level. So this is where pretty much all eyes will be looking at. The fact that we broke through this other low, which at 6,400, we've pierced through it, which we did earlier today. Let me zoom in here. I'm going to go back to auto. You can see that there are these wicks that have broken through. Obviously, those are fishing for margin call. They're trying to get all the stops out of there. But when you look at the momentum of this waterfall of downward pricing, this is going to be This is going to be hard to. It's going to be hard to reverse that off of this previous resistance level. I could eat my words on that, but at this point, I think 59 is really where the eyes are focused and probably should be focused. Once we get past that, we get down to 4,900, which, not to make light of it, but it'd be pretty wild if this was the order that got filled after last year, when I was like, oh yeah, I think we were at maybe, I don't know, like right around here, maybe like 11,000. And I said, I'm going to put a standing order to 4,900, and look at that 8 months later. Not that I want it to happen, but who knows? So that's what we're looking at. 5,900. None of this is pro advice. This obviously could bounce up, but that's what I'm looking at. A lot of people are probably sitting there being like, do I sell? Do I not sell? What do I do? Do I hold? I can't tell you what to do. Nobody can really tell you what to do. I think that what you do need to recognize is, what are your options? First option is, you sell. It doesn't need to be binary. You don't need to sell everything. If you do sell, you can sell a little bit, or sell 50% or 20%, or whatever. You can consolidate. Right? Maybe if you're taking a loss, you get it's a tax benefit or whatever, as opposed to, taking out, when you sell way up here, you make more money, but you also got to pay more taxes. Not everyone, right? Obviously some countries don't, but there's a lot of implications of that. The other thing you can do is you can get an account in something like Kraken or Bitfinex and BitMEX if you are non-US citizens, and you can do what's called the Delta hedge, where you take leverage and you basically do a short position that's equal to or comparable to your total crypto position, so that and you go short, so that if it goes down, you're making money on the short while you lose money on the long, but you break even. And then vice versa. If it goes long, you're breaking even on everything until we get a clearer picture of direction. If you don't know what that is, if you want more information on that, Google delta hedging. I think it's something that a lot of people don't do enough of, and it can help a lot, especially if you're in the United States, and there's tax implications, especially if you got in early, and moving into fiat can be tax. So there's just all these things to think about. And yes, we talk about plans and strategy. That's the kind of thing that you want to be thinking about. All these different pieces. How much do I have to go in? How much do I not have to go in? What's the price, the lowest price that I'm willing to go? And realistically, it's as low as you think you can go. It's probably not that low. So keep that in mind. I think the other piece is that I think everybody's in a unique position. Some people may have put in more money than they should have. Some people put in less money, whatever. And some people got in earlier. Some people got in later. So I would never be so bold as to assume that I know anyone's position. But what I will say is that the more you teach this as a learning experience, the more that you'll be able to capitalize on the next market opportunity, whether it's in crypto, whether it's in Bitcoin or altcoins, whether it's in stocks, whether it's in something completely different, Forex or something you get interested in. There's a lot that you can learn by going through this. And that may be the last thing a lot of people want to hear, but I think it's the best way to make the best out of this. Short, aside from just straight up going short and making money on that. So that's where we're at as we watch Bitcoin make another dip down to 72. So we'll keep it on that 5,900 level, rock and roll. EOS, I think, is interesting. I want to follow up on this because we talked a lot about EOS, and we talked about the pros and cons of EOS, right? They have a huge amount of money. They have very ambitious founders and team. At the same time, they have some centralization concerns. They have some tech concerns. But overall, it in my opinion, it still has a lot of potential to at least move the needle from a market standpoint, or I should say, like market cap wise, like it could move up or down. I see EOS as having the firepower to do so. But what I think is really interesting is as this mainnet launched, they needed a certain percentage of people that voted on it. I believe it was like 22%. And they couldn't get enough people to vote, EOS holders, which means that there's a lot of people that own EOS or are staking EOS that are just purely speculators. They don't care about the voting. And, maybe just people don't know about it, or maybe it's on exchange. They can't vote. Who knows? But I think that this is a really good indicator of when you're doing your research on a coin, like theory versus practice. This is why I'm very bullish on exchange coins, because they make money. It's a very clear incentive play. People are going to exchange coins whether the market goes down or up, and these coins are probably going to continue to do well. You look at something like EOS or any of these governance protocols, no blanket statement, but they assume that people are really going to vote and be involved and like really care. The same way that some of these publicly traded companies, Tesla, Apple, whatever, they're like, oh, well, shareholders have voting rights. But how many shareholders actually get up and do voting? Like usually the people who own a lot. So this, to me, from a bigger perspective, is less about EOS, and it's more about the coins in general that assume that people are going to care about being involved in the network or the ecosystem beyond just transactions or speculation, which I think is not necessarily an indictment on some of these ambitious crypto models, but more of it's a really good data point when I see a coin that's like, oh, we're going to do this because all the people in our network are going to participate. I've always been very skeptical of that because I'm like, that's business models have a very hard time when they're built on people giving up convenience, like when they're built on people being productive. That's why marketplaces can often be difficult, or not even marketplaces, but getting people to do it unless they are naturally productive or incentivized to begin with. So it can work. So we'll see what happens with EOS. Obviously, this is highly tied to Bitcoin as we watch Bitcoin just plummet down right now. Sorry, I don't mean to make light of this, but whatever. Let's refresh the old coin market cap. So one tweet that I put out yesterday, the market cap down another 10 billion today, is that this market cap is right around where it was Thanksgiving. And some people, I think, took this as a bullish sentiment. I didn't really mean it to be bullish or bearish. My personal opinion is I think that is a sign that there's just a long way, that there's a lot of people that still own crypto that have not been shaken out. A lot of these early adopters, a lot of these early holders, you get down, I'm not saying we will, but if we get down to like 2,000, again, I don't know if that's going to happen, but that would change a lot of people's who've been in the game for years and years. They would change a lot of their feelings on whether or not they're going to hold, because now they're breaking even. That has a big psychological impact. So, take it for what it is, but I think that market cap is really interesting. The dominance, no surprise, is going up. People selling all their altcoins into Bitcoin. That's why you see Bitcoin or altcoin prices sliding more than Bitcoin, with the exception of a handful. OMG doing really well. Let's see who else is doing really well. Decred's doing really well. That's interesting project. But again, day-to-day fluctuations, it is what it is. The exchange fund is doing really well. The one that kind of micro fund that I made. Two pieces of news. Coinbase released an index fund. Now, they only release it to accredited investors. So if you're not accredited, you're probably thinking to yourself, well, who cares about this? But this is going to be a very big deal in the next, once things start to flatten out and start to potentially even go up, this is actually going to be very exciting for, I would call it like high-end retail investors. Out here, a good example of that is somebody who works at Google. They make $300,000 a year or whatever, and they want to be in crypto, but they don't really want to own it. They don't want to have a wallet. They don't really know much about it, but they're like, this is an interesting play, and they can buy into this. I've talked to plenty of people that are in that position. I mean, even in where, places I work and events I go to, this idea of an index fund is super interesting to a lot of kind of upper middle class people, at least in San Francisco, which I realize is a very small microcosm of the world. And so this may not seem like it's the biggest deal right now, but I think that it will be a big deal down the road. Now, this is a synthetic fund. It just tracks the coin's price. It doesn't actually own the coin. So that's one issue. But I think that the marketing side of this is so great that it will do a lot for the price of the coins and just the exposure to people to go buy the coins themselves, to own the actual assets as custodial gets bigger. All right. So I thought this was super interesting news. Obviously, it's unfortunate timing with the market, but so be it. Coinbase also listed Ethereum Classic. To me, that's not really that big of a news. They're going to start listing tons of coins because they need to get this index fund. This is the real play. This is where the real money is. It's not in listing those funds anymore, or listing the coins. It's all in the fund, and this is where the big money is, like the fees and the management and custodial. On the flip side, so Coinbase Index Fund, kind of bullish, so to speak. Tether coming out. Looks like there's some new research coming out about Tether, some FUD, all about how they're manipulating it. This is a bit of speculation. We'll see how much truth there is to this. I have no idea. But I do think that it's easy to brush this stuff off as FUD at times like this. It's also very hard to know the truth. But I do think that whenever I see something that has to do with exchanges and exchanges being, what do you call it? Like there's something like off about the exchanges. That's the kind of stuff that I dig deeper into, because they are the gatekeepers, and because they are where the price is set for the most part, and they historically have been. There's potential manipulation. These are the kind of articles that you want to look into as like threats to the market, as opposed to 95% of everything else you read on these sites. So we'll see this. We'll see what happens. But if anything, when it comes to exchanges, keep your eye keep your eye on the news that has to do with exchanges. I think that's going to be a very big deal in terms of like true price discovery for crypto, at least. Okay, the last piece I wanted to talk about is, let me go to this latest tweet. So this morning I tweeted about the next 48 hours will begin the final stretch of this global macro cycle, which ends with central banks and the world realizing it is a doomed system. Trade of the decade won't be who wins, but a bet on who fails last, which will probably be the United States. Now, this is not I'm not trying to be like, oh, go USA and the rest of the world sucks. Not at all. This is just purely from a financial perspective, how the global economy is set up. Now, what this means, this does not mean like the stock market's going to crash or that anything is going to happen necessarily immediately. It just means that the tide is starting to turn. And you know how we talk about divergences a lot on this channel? There's going to start to be a divergence in where money goes. And I think that a lot of money is just going to get pulled into America. And there's a reason why for that. And I put together a very brief and hopefully helpful, very simple PowerPoint. And for anybody listening on the podcast, this is honestly it's 3 boxes with the first one on the left is the federal funds rate, which is like the Federal Reserve, United States or Europe or whatever, Japan. They come out and they say, here's the federal funds rate. Here's the interest rate that we are setting for the country for this particular moment. And if you don't follow that stuff, you go look it up. There's a federal funds rate, which is what they set. And then there's the real rate, which is the federal funds rate minus inflation, because that's actually what matters. So right now in the United States, it's actually negative because inflation is around 2%, federal funds rate 1.5% or 1.75%. And so we're negative. Like that's a big deal. And a lot of people think that, we've been raising rates, but we're actually just normalizing where we should be. Like we should be at 4 or 5%, but we got a long way to go. But we're in this weird position where the economy, the stock market's doing really, really well, and we're raising rates, which makes people very nervous. That's why one of the reasons why there's fears of, hey, maybe we're in an equity bubble, maybe the stock market's very high, which I tend not to think. I think the summer is going to be, who knows what's going to happen. We're seeing a little bit of, kind of fear creeping in, but I think we'll have a blow off move, right? Like I think it's going to actually look very similar to what happened over here in crypto with Bitcoin. I think that, you look back in November, I think we may see something like this where it pulls back, over the course of a couple weeks, and then it just starts screaming up. Obviously, I don't think it's going to be like a doubling of the stock market, but it could have this sort of like crazy run that nobody expects, and then we go from there. So the tweet I put out today, the U.S. is going to talk about their federal funds rate. Everybody's expecting it to go up. And it's hopefully going to go, or not hopefully, they expect it to continue to go up for the next few quarters. So 3, maybe even 4 times, 25 basis points, give or take, every time. So if that happens, if the federal fund rate goes up and the guidance for future is that, yes, we're going to continue to do this unquestionably, that's baked into the price. what happens is that as your interest rate goes up in a country or in a region, typically the currency price goes up as well because it becomes more valuable to have that currency, right? So if the interest rate, goes up to 3% at some point, people will have you put more money into US dollars because they're going to get a higher interest rate on it relative to other currencies. So you can keep money in the bank. You can actually start to get a return, which is probably foreign for many people in the last 15 years. But you go back and you look at the last 40 years, I mean, we've had interest rates as high as 10%. You look at places like Brazil, you can just put money in the bank and make 10%. Right? So high interest rates are not crazy. And that typically makes the currencies much stronger because it sucks liquidity out of the system. People, like, the dollars become more valuable. There's a lot that has to do with exports and things like that. Currency price goes up. What happens is that the equity markets typically go up while the currency prices go up. Now, this is where it gets a little confusing because often people think that as the stocks are a leading indicator, or that currencies are a leading indicator. But in fact, they can rise, and often they do rise together for a while. But when the stock market starts to go down, right, like this, what happens is that the Fed drops the interest rate in order to devalue the currency, which heats up the economy, increases inflation, increases exports, and it hopefully reverses the downward momentum of the economy and stock market. All right. So that's the very basic relationship between the interest rate, currency price, and the equity markets. None of this is necessarily like it. It happens kind of very loosely and often, but in this happens first, and direct or correlated way, causational way even. And so what I'm saying is that the U.S. is theoretically going to continue to increase the federal funds rate, increase the interest rates. The currency, the strength of the U.S. dollar, therefore, would continue to go up, which it started to go up. It's taking a bit of a dip, and kind of like the equity markets. I think for the next few months, no one really. It could go down a little bit more. Euro could go up, whatever, and the equity markets are going up, right? So this all happens. And if this keeps happening, right, like our stock market becomes a valuable place for money, our currency becomes a valuable place for money, and the Fed is just adding to the fire by continuing to increase the interest rates, right? So that is what's happening right now. Now, if we lived in an insular world, that would obviously not be sustainable. Eventually, the stock market would go up and it would go down. The Fed would have to drop interest rates again, and it would drop the currency rate, and it would reboost the economy, blah, blah, blah. However, we are in a very unique time where this is happening in the US, and then over in a place like Europe, they are running into very unique problems where the European Central Bank is this kind of federal currency, and then you have all these countries that are individual, like they have their individual countries and their individual debts. So you have a federal currency, but you have almost like states that all have their own debt problems. So this Fed funds rate in the ECB, in the European Central Bank, and the currency price is not necessarily tied to equity markets or to individual countries. So you see something like Italy or Greece and even Spain who start to show very real signs of debt, of problems. But the ECB is not going to cater necessarily to what Italy's problems are. They're going to cater to what the European Union is doing. So if Germany's has really good strength, but Italy doesn't, the ECB could do what they do with the currency to favor a particular part of the European Union. And what happens is that exacerbates the problems of certain parts of the European Union, and it causes certain countries to get stressed more and more and more because the ECB is catering to what the blended average is of the whole place. And if you have if these different economies are doing very different things, you can't have one currency, or it's very difficult to have one currency and one fiscal policy that caters to all of them. So over in Europe, they're going to have to decide, well, do we lower the currency? Do we raise the currency? Do we go dovish, which is lower it? Do we raise it? Do we go hawkish? How do we affect the currency price? Because if they raise it, that could really hurt countries with a lot of debt, like a country like Italy. But if they lower it, it could really hurt or it could overheat economies that are doing really well. It could cause massive inflation. So how do you balance that? And so as this all happens, right, the long-term kind of macro implications of this is that the losers tend to get the attention. So if something's dragging it down, it tends to have to cater to that before it can really support the people that are doing really well, the countries at least. So the currency price starts to go down. If this happens in Europe, what happens in the United States as it's going up is that they're both going in opposite directions, but it starts to create this what's called reflexivity, which means like as something starts to kick off, it starts to go exponential because it's a self-fulfilling prophecy. And so money starts to flow into the United States. And this problem is not just in the Europe. Europe is just kind of the next big example. I mean, Japan's run into this for a very long time, but they've done such insane things with their currency that it's hard to know, and they're still considered a reserve in some ways. You know, China's kind of in its own world. I think long-term China is probably going to be a very big winner, but that's maybe 5 or 10 years down the road. This is what's happening like now in the next 12 to 18 months. And what I think you're going to see is the ECB and the European Union and the euro itself running into all these problems while the U.S. currency and the U.S. stock market does well. Money starts to come into the United States. And as money comes into the United States, it actually supplants any need for quantitative easing, lowering interest rates, because we're getting all this new international money. So the Fed is going to say like, well, we don't need to lower rates because all this new money is coming in. All this liquidity is coming in, which typically would come from lowering the interest rates, which come from bonds, right? Like issuing bonds. But if you're getting it from international places, you don't necessarily need to lower your rates. So they keep going up with the rates. The currency price keeps going up. The U.S. equities keep going up because people are buying U.S. equities from international places, from Europe or whatever, which feeds into this problem of Europe is losing money. The economies aren't doing well. They need to continue to depress their currency. They continue to try to stimulate things, but it screws certain countries and helps other countries, and it fractures the EU in general. So I don't think it's going to play out exactly like that. No one knows the timing. But what I do think is going to happen is that you're going to see you're going to start to see very clear signals that this model of using central banks to control money supplies or control interest rates, I should say, M2, right, the whole thing, that's going to be shown very, very soon that this is not a real or sustainable model. In fact, it's a very broken model. And I don't think that doesn't mean the U.S. is immune. It just means that they're probably going to be the last ones standing. So you might see Europe go down. Britain's going to have some issues with this. Japan's going to have some issues with this. You look at all the major economies, right? All the emerging markets, Canada to a certain extent. I mean, Canada's got a crazy housing crisis. Same with Australia. Basically have the same credit bubble we had in 2007, but in those countries, right? And with this whole trade tariff war that the United States is going after, it just exacerbates this problem. And so the whole idea is that if the U.S. is the last person standing while all these other countries or areas, central banks, can't sustain it long enough, if we can hold off the longest because we can absorb the money, there's one place the money goes and everything else falls apart. How this plays out is that I think in 2020, 2021, somewhere around there, it gets so bad where they have to do some sort of global meeting where they're like, we need to repeg the US dollar. We need to devalue it. We need to do something because there's just too much money leaving other parts of the globe, leaving emerging markets, just getting sucked in by the US dollar. Now, again, this is one theory. I think that many other people would maybe say the opposite. They say the US is going to crash first and Europe is going to absorb a lot of that money, or that emerging markets are going to innovate even faster, especially China, and the US is going to go first and whatever happens that way. But I tend to, if Trump wasn't the president, and this is not political, nothing to do with him, if he wasn't the president, I would tend to agree that the US dollar was not going to be the place where it comes. But the fact that we're doing all this trade stuff, the fact that we are really creating like an isolationist policy, and that other countries are starting to do this as well, that fuels the case that money's going to flow into the US. After that happens, I mean, who knows? I mean, buy some gold. But I think also, for like taking this full circle, once all of this goes down and there is this huge, oh my God, like this Federal Reserve thing doesn't work. And there's like this huge question of where's money go, where's assets go. That is when crypto is going to step up to the plate big time in an asset class. Between now and when that happens, there's plenty of opportunities for growth, especially with assets, building companies, making money on companies. There's a huge opportunity. But from a massive, like maybe even currency level, but just from a huge adoption level, I think this needs to play out. It's going to play out probably quicker than people think. And then crypto, like Bitcoin or Bitcoin Cash or whatever the thing is that's going to win, gets its time to shine. And that's when it goes huge. So, I mean, I used to look at this kind of stuff. One, I would be like, what do I do about it? Like, I don't care. Then I started to look at it and it was depressing. Now I look at it and I see opportunities. And this is hopefully what I can pass on to anybody listening or watching this, is that change is when you make the most money. When things are just good, right? When there's a bull market or whenever, yeah, you can make good money there. But when there are shifts like this is when you make like fortunes. And my whole thing, like I've talked about, is being ready for it, knowing what to do. Like if I told you, hey, or not, if I told you, if you had a very good case, it's like the euro, right? Let's say you're like, I'm going to go short on the euro. Would you even know how to do that? Would you have the ability to do that? I'm not saying you should or that you want to, but I realize that is something that I want to be able to do because I'm interested in it. And I think a lot of people would be interested in this kind of stuff if they just knew more about it, and they would look at Bitcoin and crypto differently. They would start to think about this all differently in a bigger picture way, not even as a trader, but just as an informed investor, as an informed global citizen, so that you're ahead of the curve. You can see this kind of stuff starting like coming and you can take action on it. So a lot of what I'm doing right now is not really trading. It's getting ready so that when someone says, hey, there's this is going to happen in the stock market, or there's a high percentage chance of this, I'm not going on like E-Trade and buying an ETF. I can go into a futures trading, CME, and I can trade with leverage, and I can actually make real money off of it, off of a huge liquid market, as opposed to just going $1 to $1 and making the 3% or whatever on the stock market move. Like 3% in futures is insane. 3% in Forex, that's real Lambos. So I hope this just gets the ball rolling. I would encourage you guys today, tomorrow, keep an eye on the news, right? Like look at what's going on here. If you're looking for resources on this, obviously tomorrow I'll do we'll look through the books on the Amazon store and I'll give you some insights. If you're on Twitter, look at the people I follow on Twitter and maybe start following some of them. There's a lot of really good macro thinkers on there. And if you want a really good resource, check out Real Vision, REAL Vision, VISION. Is that how you spell vision? Not sponsored. This has nothing to do with it. No, I don't get any commission. But they have great stuff and they have a free YouTube channel. So you can get like clips of what it is. But I recommend their service. They have some great stuff. And they have people that would support this theory, and they have people that would tell you that this is not, the dollar is going to tank and that this is not going to happen at all. The U.S. is going to go down before anybody else. So, but yeah, Twitter's probably the best place to start. Look at the people I follow, check them out, check out their profiles. You don't have to follow them, just see what they're doing. And there's a lot of interesting ideas and just get this stuff. I think that this is really important information that I think that I wish someone had explained to me 10, 15 years ago. Anyway, that's enough of that. Exciting times. It's going to be, as Paul Tudor Jones said in a recent interview, the next year is going to be one of the most exciting times to be a trader, or at least to be an informed investor. And I think that, that's what this is all about. It's about mastery of coins, markets, anything. Cheers, guys. I'll see you tomorrow. All right, peace out.